Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related item on these my charts. This was all my own original work, as I think you deserve to have that. So with that, ice raw sugar in New York. The main pattern here since September 2024 had been, I suppose still is after a fashion of sorts, is the breached and seemingly repaired dark blue September to December 2024 bear channel, currently at 1305 to 1711, that has developed into a descending expanding wedge pattern. However, since February, another pattern, the bright pink late September 24 to mid-January 25 bearish Andrews pitchfork, which I drew 26 weeks ago, seemed to be a better contender in showing the bearish angle of attack. But on this one, 4 weeks ago, we saw prices push up through the upper time, and that's currently at 1546. I asked this question 3 weeks ago, was this a true break upwards or just a breach higher? Now, the reason I asked this question was because ever since then, and I say this carefully, this breach higher, we have seen prices turn back lower, so it's a breach higher, back down towards the breached upper time, having been capped by the overhead descending mauve medium moving average, currently at 1669, and running down along the top of the breached pink upper time. There is also another pattern complementing the other bearish pattern seen here, a longer term bright red November 23 to September 24 bearish shift pitchfork, which has even now after so long been pretty good at showing the bearish angle of attack, though over a longer time period. On this one, we are today, as we have been for most of the last few weeks, hanging around the bright red middle time, currently at 1566. Plus we are back below the green slowly declining short medium moving average, and that's currently at 1626. Now, overall, I suspect something is going to give, and soon, and I'm on the watch out for what it will be. Just be aware, last Friday's close was the second lowest close we have seen since mid-April 2021, and that's something to bear in mind. Thus, looking below the broken pink upper time, we have little bar the late June low at 1468 until the congestion zone between 1379 to 1409, containing the December 2020 low at 1409, and the interesting 21st century 61.8% absolute Fibonacci line at 1382. Ice Europe white sugar in London. After all this time, there still continues to be three features of this market to keep bearing in mind on this daily chart. The first of the three patterns is the obvious and broken, then repaired, and then recently broken again 4 weeks ago, purple late September 24 to mid-February 25 descending expanding wedge pattern, currently 465.92, way off the bottom of my daily chart. This pattern had more than the requisite 5+ touches necessary made back in January this year, and been severely tested on the top side, especially between late February to mid-April. Enough that I would not necessarily classify as a descending wedge pattern after February, though I'm still keeping an eye on extension to the upper trend line, as I believe it to be significant. After the break higher on this, seen back between February and March and on the way back lower, I asked you 19 weeks ago to, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitchfork. This is a very shallow pitchfork, and the more the market moves lower through it, the more I'm beginning to like it. End of quote. Well, since then, the market started utilizing the bright pink middle time of this bearish shift pitchfork, currently 472.60, as an attractor, riding prices low in a shallow glide until about 15 weeks ago. Since then, we seem to have become caught in the well-highlighted overhead congestion between 489 even to 490.10. It's quite a narrow range, but there you go. And the bright green extension to the April 21 to June 2021 head and shoulders neckline, and that's currently at 493.5, with a single attempt higher that was tapped back down again last week by the declining gold long moving average, currently 504.80, and held up below by seeming support from the February 2020 high zone at 456.70. I asked the following question 7 weeks ago, and I quote, "What it seems to come down to is whether the market has the bullish incentive to push up over the pink middle time, the purple upper trend line, and the bright green neckline extension right now." End of quote. Last week it had enough of a bullish incentive to do that at the start of the week, but not enough to sustain the move higher, only making just a one single close over all three before falling away to make last week a weekly key reversal down, a very significant pattern at that point. However, as I said 5 weeks ago, and I quote, "There also seems to be no immediate appetite to push too far lower right now." End of quote. And actually continued, and I quote, "It all depends on what happens between where we are now and the February 2020 high at 456.60, because I imagine under that we might well see some fresh sell stop selling emerge." End of quote. Now, the reference to where we are now was back then to the May 2017 high at 469 even. And indeed, I would extend that, as I said 3 weeks ago, and I quote, "In that it all depends on what happens now down below the February 2020 high at 456.60 and over the green neckline extension, currently at 492.90. As I suspect that despite the overall bearish pressures, we may see a sideways rectangle pattern start to emerge between about the 456.60 level below and the 493 level above." End of quote. Now this rectangle seems to be what we are seeing now. Sugar white premium spread. Things seem to be trying to resolve themselves into a pattern. We have a dark blue uptrend, currently 117 even, that despite being breached on a number of occasions still seems to be holding up. This now ties in with the green lower tie, currently at 116.25 of the mid-November 24 to early June 25 bullish shift pitch hook, which reinforces this pattern. However, I have a fear, and it is a real fear, that the whole February 25 today action may be trying to form a possible diamond pattern. This would be a large pattern in time, probably from February through to November this year, and actually in high also, roughly between just under 100 up to 150. Now, it's too early to say if this is happening, but I would urge you to keep an eye on this possibility. So what have we in the way of supports and resistances that may influence the market? Well, apart from the already mentioned supports below, we should very much look at the long moving average below, currently at 100.5, par and a half, as this interfered with and in its own way held up prices earlier this year. Below these, where we don't have that much support until the congestions below starting at 85 even and stretching down to 70 even. Now, looking topside, we have last week passed through the twin pair that were overhead 50% Fibonacci lines at 128.75 and 131.25 for the July 19 to September 22 move and the August 21 to September 22 move respectively, and the congestion at 134.25. However, as I said 3 weeks ago, and I quote, "I'm not inclined right now to view these in a favourable light, as they have been breached before quite sharply, despite only once having a weekly close anywhere within them." End of quote. Nevertheless, they have now become supports of a sort, I suppose. Above these, well, it was, as I said 5 weeks ago, and looking at the top side, and I quote, "a fairly free area overhead, but it ran into the significant 2013 high at 152.75 and swiftly turned back down, just as it did back in mid-April." End of quote. Now that area overhead up at 152.75 seems to be the better resistance right now. As for the others, well, they seem to just abrade and whittle away the bullish incentive, but on their own they do not stop it. Last week we came up against one of these abrasions, and that's the bright green middle time, currently at 141.5, that capped the rise but has not stopped the market from trying higher this week as we've gone up from the open, or seemingly any week in the foreseeable future, unless unless we have that pattern I mentioned right at the start of this commentary, and that begins further forming, and that's the large possible diamond pattern.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.